Hello, ladies and gentlemen, and welcome back. Well, it's finally happened. The level that stopped every single one of these bull market runs so far in 2022 has basically been reached. And along with that, we're getting and approaching a significant gap fill. What was happening? Well, it was Jerome Powell and his speech about the Fed policies that changed the game. The question is this a real rally or is this trapping dumb money similar to what happened last time? Today, hopefully we have some of those answers along with what the bond market is telling us about rates moving forward. This was sure to be good. See you soon. Well, welcome back everyone to the Daily Show where we talk about stocks, commodities, and cryptos. We've got the macro data, the news headlines, the lead indicators, and the key levels that you should be watching right now in the markets coming up in today's show. But let's begin with the headlines. Stock traders cheer Powell's risk-friendly shift. We've also got article here from Reuters saying Fed's Powell rate hikes to slow but adjustment just beginning. But let's actually look at the statement. I think one of the biggest comments that was made is the time for moderating the pace of rate increases may come as soon as December meeting. What does this mean? 75 basis points are pretty much officially gone now, and the market is expecting 50 and then 25 basis point hikes to continue after that. It really changes the shift here from aggressive rate hikes to slowing pace to see how the economic data is coming through. It doesn't necessarily mean an incredible pivot though. Let's read a quick excerpt here. Given our progress in tightening policy, the timing of that moderation is far less significant than the questions of how much further we will need to raise rates to control inflation, and the length of time it will be necessary to hold policy at the restrictive level. It is likely that restoring price stability will require holding policy at a restrictive level for some time. The market's agreeing with that. We'll show you soon. History cautions strongly against prematurely loosening policy. We will stay the course until the job is done, emphasis added. So really, it's kind of like the tools discussion. Yeah, we're going to use all the tools. In this case, we're going to stay the course until the job is done. What does that exactly mean? Well, I think we've got some idea. It basically means that yes, rate hikes, of course, no more 75 basis points, still going to a 4.8 to 5% terminal rate in terms of where the yields are going to be, but they may become sticky inflation and therefore we have to stay at a higher rate than necessary for a longer period of time to kill that inflation. You've got to get inflation down underneath and hold it there. If you haven't already, make sure to watch and follow along with @FX Evolution on Twitter. We are posting there a lot more, including some of our private reports. We've got one coming in less than 24 hours for people for free. Of course, if you just follow @FX Evolution on Twitter. Let's begin the macro side before we get into the charts and look at the terminal rates and look at the yields and the bonds and everything that's going on and what shifted in the last 24 hours. But let's begin with smart money versus dumb money. We know there's a shift here. Smart money has been reducing their positioning in recent weeks and bringing on the hedges in terms of shorts, and dumb money has been taking over. Now, this cross has often been a very important point. Let's look at some of the other peaks this year. Again, do you notice something here? Dumb money, smart money crossed before. The market made one last push, and then all of a sudden it came back down. Over here, we saw smart money and dumb money cross, and of course, after that, we saw that sell-off. So this indicator is showing us that maybe people are getting a little bit more FOMO and a little bit greedy. And I think in the last 24 hours, most people in the comments section, especially if you're mostly bearish this market, would either unfortunately be feeling the pain of what just happened, but more importantly, would also be feeling some sort of potential regret about not being in the markets. This is what happens. Fear and greed. If you were to say, let's talk about stock market, I could just say it's a fear greed market. And that's what it is. People are going to be feeling the FOMO. It's important at this time that you practice having a great temperament in trading. If you've missed an opportunity, doesn't matter. There's always another one. I just wanted to say that before we get into the rest of today's show. Let's have a look at SPY breadth percentage. This has theoretically been an incredible indicator for finding further rally points in markets. You can see some of the other times it's happened over the last couple of years. And this year in 2022, it showed actually up near the peak. We've got it happening again. Does this mean that it's another trap or is it a real breadth indication. That's a good bullish indicator usually. Will it be again? Here's another SPY breadth in terms of what happened back in 2001 when we got a reading similar to this. When we had one of these recoveries, you can obviously see what happened to the market. It went down afterwards, so it was a false rally. Here is an example of what we've got going on right now. Of course, this is SPY breadth again, above 200, and this is for XLI in terms of the industrials. And you'll notice again, we've got that recovery. We've got a very similar signal. Will it be like 2001, 2000s and be a false signal that moves down? That's, of course, just the bear side look at breadths. As we know, it still has been historically a very, very good time. Seasonality, I guess, is coming along for some of the ride. Generally, seasonality now will tick down after that initial little bit of a burst that happens in the start of December, maybe 1-2 more days of potential going up very slowly, or maybe even a pullback with a rally in it. We'll talk about the scenarios later on. Then we tend to get a pullback into the middle of December with the Christmas rally. Now, that's during normal years. Of course, we're in no normal year, but it's interesting to state. Now, we were talking as well about Thanksgiving. Negative times into the end of the year tend to be flat. Of course, at this point, we're up a couple of percent. So we're up probably about 2-ish% from the peak. That's showing us that maybe we're starting to run away. I mean, the NASDAQ was up over 4% in the last 24 hours. So are we going a little bit too high from the averages? Well, you would say yes, we're starting to get up there in those peak areas. So a bad 2022, could that mean hope for 23? Usually, yes. The bull side is incredibly positive. You can see here all the other negative years in midterms. They're all green. The question is, when's it go green? Is it going to be green now, red later, red through the middle of 2023, then green, huge bull move into the end of the year? Still up for grabs. We don't necessarily know that we're in a bullish environment. I know a lot of you out there are going to say, no, Tom, come on, man, this thing is recovered. But there's still problems behind closed doors. As we know, the Credit Suisse situation continues to be a thing. No one's talking about it. Yes, we may have China potentially opening up plans into next year. Yes, we might have the Fed saying maybe we've gotten to a restrictive policy. What is the damage that's being done? We don't know that yet because we don't have the economic data of how bad the economy is going to fare, especially in valuations on stocks. And expect 2023 to be all about earnings seasons. We're going back to earnings. I'm pretty sure of that. We'll find out, but I'm fairly confident it'll be all about earnings in 2023. Let's talk about here with the VIX. The VIX is still down at 20. Now, this is exactly what we really wanted. Many people were talking about the VIX, us included, and we wanted to see a 20 VIX with the trend line getting hit. Well, we're getting that wish. As we know, when the VIX has been low, similar to here and similar to here, this has been where realistically bulls need to be cautious and bears need to potentially now start to play the game of statistics, options, whatever else they were thinking about. It's happened. If you're patient enough, we're at this level. And this has been very, very good. The VIX is a great reminder of fear and greed. In fact, that's what it's showing us, really. And remember, the market, if we want to break it down, is just those two words. Let's move over now to US yields. So we saw the 2-year yield go to 3.6%. I'm sorry, the 10-year. So the 10-year yield, 3.6%. Now, the 10-year yield, yeah, this is showing us a very important sign. It's showing that cuts need to come. Remember, the 10-year yield is derived from the market. That is, the market really dictates what the 10 years worth, and the 2-year is more of the Fed. Now, the Fed did drop the 2-year yield 4.32% versus, of course, what happened with the 10-year. Let's have a look at the yield inversion. So we'll type that in now. This is the combo. Press enter if you ever want it in your TradingView platform, and you can see we are still heavily yield inverted. And this is still a worry because being this heavily yield inverted, it's not good. I mean, I've never seen it in my trading career, of course, which spans over about 14 years. I haven't seen a yield inversion like this, so we're not exactly sure how bad things are going to get, but I don't ever ignore yield inversion. The markets are scared about what's coming for sure, although it may not look like in price. Let's go over here to December. So December, we expect a 4.12% in terms of where we're going to be with rates. Then by April of 2023, we're basically now hitting what we call the terminal rate. So we've had that as high as over 5%, but it's still very sticky, 4.875%. So still very high here in terms of where yields need to go before they hit that topping level. And then hopefully inflation will come underneath, which looks very positive at this point that it will. But then it needs to remain low and stable for a period of time. Then the Fed will be able to do the cuts that are needed to support effectively what will be zombie companies and also many, many companies and economies struggling heavily. Remember, we're only just in the beginning of this, and Credit Suisse is already starting to struggle and get bailouts from everybody else. By September, we're sitting at 4.84, so that means that the market will still be sitting basically flat on that rate. And then by December, we're expecting, at least this is where the change happened over the last day, we're expecting a rate cut. Notice though, it's been lower than this. So even with those comments from the Fed, yes, it went down, but it's still very, very high. And I think this is important because the markets are rallying like it's all great, but we don't necessarily know that yet. It's not really what the bonds market's even telling us or the yield market is telling us at this stage. Speaking of bonds, we saw high yields come out pretty strongly. Obviously, that is a semi-positive sign to see high yields go up. Of course, dropping of rates, people are taking on a little bit more risk. That's what is occurring, and that is what you want to see. You'll also be watching LQD as well, which will be investment grade bonds. They did have a little bit of a pull up, and in recent days, it's been a mixture signal from these. So I think we will continue to watch it. We'll bring bonds in, and if we get any signs of weakness coming through bonds and holding of the stock market, then we'll be paying a ton of attention because we know we're at a very critical potential turning point. Let's have a look at Credit Suisse. I think we'll now follow this one as much as possible. A little bit of bullishness, but it started bad. As you can see here, it went actually down quite significantly, then rallied through that session. Let's just have a look and see on the 2 hour what really happened here. I still think this is a big problem stock, and eventually something's probably going to give on it. It looks sick, and the markets are not usually wrong on these things long term. So we got a 5.9% rally from the low, and of course we dropped from the previous close at one point down 6%-ish. So we went down pretty far from the previous close, and yeah, you can just see the pressure is still on this stock. We'll continue to watch it because I still think that's the storyline potentially from the back end of 2022 into 23. Let's move over to the US dollar. What happened there? Well, it rallied. Well, it dropped down into that zone we talked about in the previous session. Then it rallied. Then it hit this supply and it dumped during Jerome's speech and afterwards. It's still theoretically showing some signs of decent recovery. Let's have a look at the daily here. You can see that supply getting hit. Where did we find ourselves? Straight back into these wicks. Notice the previous daily closes. That's where it was kind of bought back up to. So we did see some little bit of buying in the US dollar. Now, theoretically, with the market making a new high, you would expect the US dollar to make a new low. It didn't do so. So something in here is still holding it up. And this will be a very interesting chart to continue to watch over the next 24 hours. If we move over to the euro was bounding through. It went through this supply. Obviously, again, similar to the DXY, it dropped, then it rallied, and everything was looking pretty good for the short. Then Jerome came and put the knuckle duster on that. He punched it out and said, no, it's coming back up. So that's where we find ourselves basically at a fairly critical point here for the euro. Certainly at a chance of turnaround right now and around this area, but we haven't seen the signs of it just yet. If we go down to the smaller timeframes and we want to set alerts, I think we're looking for at least a market to get back underneath here. So we've got a high and a low and currently have that higher high. We're looking for that to turn down, possible rally and then short, if that's the way you want to do it. At this stage, of course, these are probably the harder trades compared to the market. Let's move over to gold. Gold rallied. Unfortunately, it wasn't able to do the business on the previous session. Now, we did come up to this supply again before Jerome's speech. What happened? Wick rejections off the supply. It dropped pretty significantly. So if you were actually on the short side for the session, you were doing pretty well. And then Jerome came out and he boosted this thing up. He basically said, hey, we're going to hold rates there for a while, which is exactly what you want for stagflation potentially as well, which is great for yields. And what happened? The US 10-year went down, and gold loves that. So it's no surprise that gold was happy about a US 10-year decrease. It tends to be how it goes. Where is gold? Well, it's coming into this critical level again. This is the zone that we saw it reject the other day from. And if it does get up here, you could look for signs of weakness. Overall, I'm still very positive on gold, as I have been all the way since we broke out down here. There's no reason for us not to believe that pullbacks won't be met by overall buy demand in the medium term. It's a very good time for gold. Traditionally, December and January are pretty good for it. Hopefully, it continues to do the right things. Specifically, GDX is another one that people have been looking at, which is those gold mining stocks. And that's just trundling on higher over the last couple of weeks. Again, it's been outperforming the market by far since we first brought it up. Let's move over to oil. It had an okay session. It wasn't spectacular. It just continued on with that bullishness, little bit of a pullback, and held this area and then moved up. Not too many opinions on oil other than it's going to have some issues with 82, and we still expect a pull down, possibly then a buy up. And the reason why is that trend line, if you draw it up on your charts, does show there. I've also been informed by a few viewers that there's a few artificial puts supposedly sitting around these areas by governments around the world. So maybe that will take a little bit longer to get to my eventual plan, which is $65 for the barrel. XLE, on the other hand, if I can bring that up here, still looks to be in distribution. So XLE still looking relatively weak. Even on the session, it didn't do well. Energy was the trade everyone was talking about. It's in a holding pattern right now. And again, breakouts down to the low, even the current weakness here that we've seen in previous days. A great day in the market wasn't enough to get it through. So clearly there's something going on with energy and the stocks are starting to weaken. Let's move over to the market. What's going on? Tesla had a stellar day, 7%. Woo! This stock doesn't relent, yeah? It didn't come back down to the level I wanted, which was 170, 173 for the bounce. We saw that weekly. That's continuing through. And we're basically now getting close to that first take profit for a lot of people. People will like this area, this 195 to 200, as locking in some of their profits from the recent dip purchase. If it gets through this area, that will be significant. So I'll set a little alert above 201, just in case that does happen. And then we'll also set an alert for the new lows, and we'll set an alert for possibly this gap fill as well, because I think all these levels are still very relevant. Nice move into resistance. Congrats, I guess, if you've been bullish on it. Good level. We'll see what happens now. Let's look at the SP 500 to try to get the details from that. Apple did a very nice session as well. It came back strong along with any of the other big ones. You can see here, nice bounce. Amazon had a big day, 4.46%. Still cheap though in comparison to where it has been. Google put on a pretty good session. Now, some people will be calling this an inverse head and shoulders in the beginning of a serious move. I think 104 will need to be breaking plus for that to occur. But hey, yeah, I mean, I can see it. And if it does end up being the thing, or maybe you have to admit defeat and say, okay, the markets are recovering. Let's just have a quick look here at trend lines and things. You can see a lot of them will line up with that zone. So there's still a ton of stocks that are right on these resistances, and it will make sense when we look at the S&P 500 very soon. Let's go through the DAX. The DAX is still struggling with this high. The last 24 hours was not about the old economy. That is oil, gas, commodities as much, or the commodities did okay. It was more about semiconductors, energy, electronics, technology, all of those types of markets. So this area here, it's still remaining a very big sticking point for the DAX. It made a slightly higher high. It's grinding higher. Options players are probably looking at this a little bit differently and saying, well, you know, we've had a great run. Maybe it is time for an overall pullback. Everyone's getting euphoric. Again, we still are holding a very critical resistance. So something to be worried or thinking about there. XLY versus XLP, it was a good session for it, no doubt. Let's have a look at that weekly. That looks all right. Daily coming up. Will it continue? Usually you need it to for a recovery to be real. Traditionally, we get consumer discretionary coming with the rally. That hasn't happened so far. It's been one of our major sticking points and worry points for this rally. It's just one of the thought processes that I go behind. I obviously want to share that with everybody here. The other one that we use is, of course, we've been talking about US 30 versus US 500, which kind of shows us old economy versus new economy. That was down on the session, which tells us that it was all about technology, and that's no surprise. Doesn't matter which one of the growth stocks you were looking at, they had a very good session. US 100, the NASDAQ smashes into that 12,000 supply again with a heavy hand too. It was a nice big candle here. That's off the back of taking the lows, and it just went rally, 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 and it was almost unstoppable. We find ourselves at the resistance, which funnily enough is very close to where we find ourselves with the US 500. So just a quick reminder, we have a gap fill that was left from that previous CPI number over here at 4110. There it is right there. We are now filling this gap, it looks like. Whether we rally through right now or we drop to 4040, hit these highs and then potentially rally up to it, it looks like a very interesting level. And I think options players will be coming in here and saying, okay, we've been patient. We've seen VIX 20. What are we going to do? Look at the volume. The volume was massive. So there was a lot of trade going on. It was a lot of FOMO. We still have gaps through these lows. Big one here from the CPI number. See how this one's probably going to fill. Another very interesting thing. If you are patient and you have that temperament, remember we say patience, react, don't predict, then you actually do often get very key critical zones, and you'll be surprised how often everybody else pulls the trigger too early. And if you're patient, you get the early bird gets the worm, but in this case, the patient person gets the worm. Let's have a look at the market in retrospective. So we had some scenarios yesterday. I'd like to run them out because I think that's important. So scenario one was we were looking for this 39.86 breakout. We had an alert set there. When that happened, it was very likely we would go to a 40.26, and I actually speculated that we'd probably go all the way. And I did that in the quick write-up that I had for the room, and I'll just quickly zoom it in so you can see it. So here we have basically that 39.86 should signify if any bearish pullbacks are after that, which of course we didn't get, they will be met by super demand, basically going to 40.26 first, which is the gap fill, and then hopefully eventually going all the way through to the 41.10. And the main reason is because we saw those wicks, we knew it was a buy, and if we take that high, then we've kind of shown again that this area here had some demand in it. There were, of course, other scenarios, but this was one of the ones that I was playing with. And the main reason was that. We did talk about it, of course, in the previous video. Now, if we'd taken the low, let's say we'd gone underneath this level, we most likely would have moved down to 3900, 3910, which is where options sit. But instead, it was all about Jerome, and he just pushed this through. And you can see it's a very fast move. Not much chance of getting on it unless you already had buy levels set or you were just marketing randomly into the market. But once it broke through probably this high, and more importantly, this one, the 39.86, it was quite strong. Let's talk about next areas now. So first up, we've got a 200 moving average sitting around here. So let's load that on our charts. You can do that by doing this. Some people prefer different moving averages. We'll just load a traditional simple moving average. Go to settings. I like to make it green. Don't ask me why. I just like green for this one. And then we're going to set a 200 on the close. So let's have a look now where the daily 200 is. So we're sitting a little bit below. Now this has been broken before in 2022 so far. It was a great level previously. We used it along with that supply. So this is now technically through on the daily. It's a pretty important level. We've definitely gone back more than you would think, but we still have a lot of resistance behind. We've got the wicks that were here, the gap fills that are sitting around that 41.10 area, and of course, the downward trend line. So what are we looking for at this point? Well, bulls are probably just happy to get here, and they're like, yeah, thank goodness we're here. What do we do now? Maybe it's take profit. Maybe it's descale. Maybe it's recognize that we just had a massive run and that we're at a critical zone. So there's a chance that the market will pull back. I think 40.40 is clearly resistance becomes support in terms of what most people will look at it as. And then there's that chance that we might push to 41.10, 41.40. That's certainly a great gap fill. If the market chooses to just be even more ballistic, it just goes straight to 41.10. But anything around here is the absolute danger zone. So it's now the structure that forms on markets that will become important. And if we do get the right structure, we may know, similar to last time, and at least have a good inkling that the bears are back in control. Remember, smart money versus dumb money, that's telling us be cautious. Breadth is saying, hey, it's pretty good. This is a pretty good rally. We should really pay attention to it. Bonds are telling us, yeah, it's not too bad. Doesn't look too bad. But then we have Credit Suisse. We also have, realistically, the terminal rate still holding for a long time. And we know that the markets will still be freaked out about bad earnings in the future. So there's a real case to be said here that the bears need to take control within the next 40 to 50 points. Will they do it? Time will tell. We'll, of course, be updating you every step of the way. So make sure to subscribe and smash that like button if you're interested in those things. Options, let's have a quick look here. 397 max pain, obviously 390, 400 being the main points, and we've got a lot of 415s and 410s starting to appear. This is not a main options expiration week, so it's not going to be too bad if it's above. But anywhere in here is, of course, even if it came back to 400, that would be pretty good for the old market right now. So a drop back would be, I guess you would say beneficial and profitable should they want to do it. I don't think it's the main cause. Now, you could say Bitcoin showed us the way because, of course, Bitcoin broke out earlier before the Fed. It's still around these critical levels. We just saw that high get taken. For Bitcoin lovers, you're probably kind of happy that it's coming through. Let's take a look at the weekly now. We do see exactly what you would want, which is a wick, a doji showing us equilibrium, another wick, and currently a bull candle. If this can close nicely bullish, then we may actually get a rally that pushes us back into these levels up here. So time will tell. Of course, the market is fearful in the crypto world. It's still very tough. I still think I'll eventually see what I want, which is that $11,500 to $9,000 mark. But yes, cryptos, the little wicks here are showing us at this stage, possibly a little bit of a bottom has been put in, and that breakout is nice. We're at critical here coming into today's session. Remember, jobs numbers coming out on Friday as well. So let's take a look at that. So here are the jobs numbers. We've got Thursday. We have core PCE price index, 8:30 a.m. New York time. So that's 1 hour before. Then we have ISM manufacturing PMI, and then we go into the jobs number. So the jobs number, it tends to be a spike one way followed by a real move the other. Sometimes it's not like that, but that's predominantly, if I was to say 7 out of 10 go that kind of way, go one way and then go the other. The rest of the time, it'll just be in the real direction. Imagine if we see the jobs number and it spikes like a 4110, gets that gap fill, and then all of a sudden goes down. It's going to be a very interesting next couple of sessions. Options traders will probably like this. CFD traders and futures traders are probably a little bit scared because it's hard to know exactly where you structure up at this point. We'll be watching the next levels for these markets. And of course, at the moment, it seems like some of the best trades at the moment that have been statistical have either been, I guess, in the stock market in the last 24 hours, or actually currencies. Different currencies other than the euro have been doing okay. Thanks so much for watching. If you enjoy the content, make sure to subscribe, smash that like button, and remember, go follow us over at FX Evolution on Twitter. See you soon. Bye for now.